Okay, so hello guys and welcome to this video, and we are going to discuss Thursday TGIF profile amplified. So a TGIF profile essentially stands for TGIF itself. It does stand for thank God it is Friday, and I am sure from the course you most likely already know what a TGIF profile is, right? So that is the assumption here, because I just want to get straight into the video because there's a lot more things we're going to talk about after the video itself. Right, so just a refresher, a TGI profile essentially is a reversal trade. Now, typically when we look at price, in terms of being able to capitalize on price displacements and also price movements, we essentially, within our weekly range profile, we have two directions to trade it. We either are trading in direction of high time from order flow, or we are trading against high time from order flow. Now, when we trade in direction of high time from order flow, that is a different profile, set of rules, and model itself. The whole point of the video is to talk about that reversal model, which occurs within a specific time. Now, typically it is Thursday, but sometimes it can occur on Friday, right? But we want to focus more on Thursday, and then of course tomorrow we're going to talk about Friday TGI profile, right? We're going to talk about a few rules and protocols, and also one of my goals with this project, it's like a little bit of a project. Mostly it has been amplified due to the fact that my last performance over the last 1 week has been unimpressive. So of course this is just my work rate coming back and wanting to just grind and try to refine just a little bit more. But essentially what I want to try to do, which would take a lot more time, and this would be for like a weekend. So we have two projects. The first one is of course the Thursday TGIF profile, and then the other one is going to be the Friday TGIF profile. Now you have to understand that there's not just one profile for Thursday. There are a few multiples, right? So the goal is to have a folder, which is what I would do with this project. Any video regarding Thursday would have its own separate folder that will go on the Thursday protocol if you're trading Thursday, and any model for Friday will also go under a Friday protocol if you want to trade Friday, right? So this is just one model. This is not all the model for Thursday. I want to clearly understand, right? So now we're going to discuss this model, and the goal after all of this is to try to backtest, right? Going back as far as 3 to 6 months. That is the plan. So the plan is to go back as far as 3 to 6 months and have an actual data in terms of a backtesting that we can use to see the performance, the win ratio, the average return, profit, and all of that stuff, right? So this will be work for later in the morning, because I have a lot more work to do for now in terms of some things I am working on for you guys. But let us discuss Thursday TGI profile amplified. And a good example actually is the price delivery we saw from today. We saw a really wonderful price delivery, not today, but yesterday, Thursday, which we are currently still a part of in terms of trading those longs and foreign currencies. So we're going to talk about that. Now, a TGI move usually is a move that is counter to the initial Monday to weekly expansion. This usually occurs off of an higher time for PDA, and this is the core basis of any higher time frame TGI profile. Now, for our TGI profile, the core basis of our any trade we took on a TGI profile, so the Thursday TGI profile or Friday TGI profile, the goal with the model is to filter out low probability profiles and only focus on the higher probability profiles. Right now, for our TGI profile, the core basis of the profile is that higher time frame reversal. Now, when we trade the TGI profile, we talk about the fact that we're usually trading counter trend to order flow, but there are times in which that Thursday TGI profile can actually be a trade in direction of item from order flow. Usually that would occur when you get a late Wednesday reversal to early Thursday reversal, in which case you can see sometimes Thursday ends up not being just a distribution cycle of the weekly range profile, but it actually ends up starting a new weekly order flow. So there's a very obvious example which I can show you guys here, which I put a couple months ago on cable, pound US dollar. So let's see if we can go find it real quick. I think it should be something we can easily reference and remember. So that was, if I can just go back just a little bit, no, pound as a dollar. So actually, we're gonna go out to daily time frame profile, and it was inside this move here, or no, this one here. So that was way back July. All right, so we're gonna focus on July, and actually let's do a replay so you can see the aftermath of all of that delivery profile. So now what you can see here with cable is, look at that Thursday profile, right? So on Thursday, the market runs up into an old fair value gap at a premium. Now there's a higher time frame primary in here, which that is not the goal for the video. But what you can see here essentially is on Wednesday we run up into that. Now look at what we do on Monday. So Monday we expand higher. Tuesday we continue the expansion bullishly. Wednesday we also continue expansion bullishly, and then Thursday we trade up into that inefficiency, and look at what happens, right? So you could say, okay, well, this is our TGI profile, and then the market runs into target objective, but actually no, the market actually runs through, right? Not only does it run down into fair value gap, it actually runs through and goes all the way down here. So this is one of those cases where Thursday not only ends up being a distribution cycle, but it also ends up initiating new order flow, right? So I want you to understand that when we talk about the TGI profile, we don't necessarily mean just the distribution cycle of the weekly range. We're essentially looking for a move that is counter trend to what we have seen between Monday going into Wednesdays, right? So if the move between Monday going to Wednesday was bullish, a potential TGIF would be looking for bearishness. If a move between Monday going to Wednesday was bearish, then a TGIF move would essentially be looking for bullishness. Again, the core basis of this kind of trade is that it occurs off of an eye time frame target objective, right? So it could be when Monday to Wednesday is bullish, it occurs at an high time frame premium, or when Monday to Wednesday is bearish, it occurs at a high time frame discount, which you're going to see shortly, especially with the examples we have from yesterday's trading, right? But going back to our slide presentation, you have to understand that when we talk about TGI profiles, we're not only talking about just the distribution cycle of the weekly range candlestick, we're also discussing in general any move that is kind of trend to what we've seen between Monday going into Wednesday. Now let's talk about the narrative profile for a TGIF trade. A TGIF reversal can sometimes end up being a higher time reversal profile, which I just talked about, or a TGIF can actually be the distribution cycle of a weekly expansion, which is what we're more familiar with, right? This is the original concept of a TGIF profile, being just that small little distribution cycle. Now, for the most part, this is what you're going to get inside the weekly range candle, where most times when you get a TGI profile, they usually end up being the second part or the second type of a TGI profile, which is just that distribution cycle of a weekly candle or distribution cycle of a weekly expansion, right? But there are those few times where that TGIF reversal can end up being a high time reversal. Now, the main question here is, how do we navigate this? How do we approach both types of profile? Remember, when we talk about TGI profile, we have two TGI profiles. Either it is a high time frame reversal profile, or it is a weekly distribution profile, right? So these are the two TGI profiles that we have. So I will repeat myself one more time. When we talk about TGI profiles, we have two TGI profiles. We have number one, the higher time frame reversal profile, and number two, the weekly cycle distribution profile. Now, we have different approach for when we have that higher time frame reversal profile, and we also have a different approach in terms of how we profile our trade when we have that weekly cycle distribution profile. So what you can see here for the higher time frame reversal profile, In a situation like this, we tend to focus a lot more on short-term trades, right? So we're not necessarily looking at just day trades, but we're looking to capture a much more significant move because we're trading in direction of highs and from order flow. And of course, if we're going to focus on short-term trades, then we're looking for our 1 hour time frame or for our time frame PDAs as our target objectives, right? So we do our targeting on 1 hour time frame to 4 hour time frame objectives because we're not day trading, we're short-term trading. And the reason why we're short-term trading is because we're trading in direction of order flow, right? So again, remember, even though it is a TGIF trade, but it is a TGIF trade in direction of order flow. So when we have trades in direction of order flow, they tend to be much more significant in terms of displacement and delivery. So we'll look to capture more of that move. So when we are trading that higher time frame TGIF reversal profile, then we look to frame our trades as a short-term trade. Generally, if we're looking at short-term trades, we like to do a minimum of a 2.5 hour to a 5 hour target objective. Now, typically, I like to do a 3 hour for short-term trades to 5 hour in terms of my first target objectives. Now this is unlike day trades. When I do day trades, I like to do more a 2.5 hour to 3 hour as my target one, right? That is enough for me for a day trade, right? So if I can get a 2.5 hour trade or something closer to that to a 3 hour trade, that is enough for a day trade. Now I'll focus on a day trade when I am trading just that weekly distribution cycle of a TGIF profile, right? So you can remember, if we're trading that TGIF profile, which just happens to align with higher time from order flow, we focus more on profiling short-term trades. And then if we're trading the weekly distribution cycle, where it is just a little bit of a retracement within the overall weekly expansion cycle, then we're looking for more of a day trade, right? So we're looking for our targeting to be on the M15 time frame to 1 hour time frame with average take profit one being a 2.5 hour to 3 hour as TP1. Now in terms of general checklist summary for our TGR profile, now what we like to look for this specific profile, we like to look for the low of the week in a bullish TGI profile, right? So for all examples going forward, we're just going to look at bullish examples during the presentation slides. Now during the examples, we can actually use for bearishness or bullishness, but on the presentation slides themselves, we're always going to use a bullish example just for ease of education, right? Now our checklist summary for our TGI profile is first off, Wednesday New York session to London close. So we'll look for between Wednesday New York session to London close. So I like to call it late Wednesday, right? So late Wednesday, which essentially is New York session / London close, to early Thursday, which essentially is Asian session to London open. We're looking for that to make a reversal at a higher time frame discount. That is, which is what is missing here. So that is supposed to be a part of this. We look for a reversal, right? And we're going to talk about reversal profiles. We look for a reversal between late Wednesday to early Thursday, right? Now that is checklist number one. Checklist number two, we are also looking for, in the process of that reversal at the higher time frame level, we're looking for a market maker hedging program to have formed, essentially a market maker model. Now, because we're bullish in this example, prior to that low of the week being formed on Wednesday, late Wednesday to early Thursday, we're looking for either a 1 hour or 4 hour market maker sell model. Because when we get that break of structure or confirmation of order flow, right, going into that Thursday New York session, then essentially it becomes a clear pattern that we can leverage into for our TGIF trade, right? So we're looking for that intra-week 4 hour to 1 hour market maker reversal model, aka market maker hedging program. C is lower time for consolidation at high time from PDA. Right, so being bullish, we're looking for a lower time from H1 M15 consolidation profile at the higher time from discount rate prior to displacement out of the consolidation. So that is what we're looking for. And then of course the last part of our checklist summary is confirmation of lower time frame structure, right? So we're looking for signs that the market has confirmed that we're seeing a potential reversal trade. Now, remember, a TGF trade is a reversal trade. Either, if it's a higher time frame TGF reversal trade or a weekly distribution cycle TGF trade, they're all variations of a reversal trade. So whenever we talk about TGF trade, we're not looking for continuation trades. We're looking for a reversal trade. So if we're looking for reversal trades, we need to apply reversal profiles into our reversal trade. Now, one of the key element in terms of a confirmation that I look for a higher probability reversal profile is a market maker or commercial hedging program, which will present in price action in form of a market maker model, right? So essentially, if we're looking for a higher time frame TGF reversal profile, we're looking for a forward to 1 hour market maker model. So let's go back to a previous example here. If we go down to the 1 hour time frame profile, right? Because now we're looking for that trade on Thursday. Now, this is a bearish example, of course, but the trade on Thursday, we're not only looking for that to be just a weekly distribution cycle, we're also looking for that to be, kind of like higher time frame reversal trade, because higher time frame order flow in this example was clearly bearish. Right, so let me just have water real quick because my mouth is so dry. Now, if we look at this example from pound dollar, and I think this is around Thursday, 24th of July. Okay, now you can see this move higher in here, right? All of this move up. We have a bit of a consolidation. It does originate from this range here, right? This is where we start to see the more one-sided expansion on cable. Now, we have this consolidation here, and then the market expands away from here. We have a level. I'm not actually going to use this one. I'm going to use this one because this goes lower than this. So we have a level where we see the market expand away from there, another level of displacement, range profile, another level of expansion, range profile, level of expansion. Again, so every time we see a down candle, price run higher, that is accumulation. So you can see we clearly have a market maker profile here, right? Which is what we talked about as one of our protocols. We are looking for that 1 hour, not 1 hour. We're looking for that H4 to H1 market maker model, right? Because it is an indication of central bank or commercial hedging program, which is a reversal profile in and of itself. It is a means of provision of liquidity by the central banks, essentially. So if we can identify a signature profile like this, that is good. That is good for our TGIF trade. So now what you can see here is it creates a clear framework in which we can frame short in this example, right? So we understand that every time the market trades out into an order block, bullish order block, we expect that level to be traded through and then act as a new level for new sells. And then we flip this for buys, right? So you can see here, bullish order block. Once he fills, guess what? It becomes an inversion, mitigation block. We sell it from there, right? Bullish order block. Once he fills, we expect the market to trade lower, right? Another, again, I'm using the lowest Anchor candle here. Bullish order block. Once he fills, inversion level, the market sells off away from there. Prior to expansion, bullish order block. Once he fills, trades up into that expansion away from there until we run the sell stop. So you can see a very clear model. And that is because all that's going on here is all mitigation, right? It's hedging. As the market runs higher, the commercials, aka central banks, will offer liquidity to longs. If they're offering liquidity to longs who are trend following, they're now underwater, right? So eventually they will look to, again, all of this is all market making, by the way. So they will look to mitigate their existing orders as the market rolls on over, they will liquidate their longs by covering with new shorts. I'm sorry, they'll liquidate their shorts by covering with new longs, right? So remember, in this run higher, they are offering longs by taking on shorts, right? That's the way it goes, right? So as the market goes up, institutions are coming in wanting to do transactions to go long. Commercials will cover with shorts, right? Now, every time they offer shorts and the market goes up, they're underwater. So as the market starts to break down lower, they will look to cover the short positions, right? They'll look to cover short positions by mitigating. And that's why you see the market return to these key levels like this. And that's one of the signatures, because it gives us an indication that there is bound to be some kind of clear reversal in the marketplace, right? So, we're going to talk about some risk factors, and then, of course, we're going to look at a specific example, a specific entry model, pattern, and example for our Thursday TGI profile. Now, there are more examples which we will talk about. Again, they're all going to go on to Thursday TGI profile. Now, let me just talk about the goal with this. Now, the goal with this is that you have, by studying the videos within that playlist, when it comes to Thursday, they are protocols for Thursday. Now, they might be a little bit bogus, but you have clear protocols for trading on Thursday, and then you have clear protocols for trading on Friday, and then you have clear protocols for trading on Monday, and then there's clear protocols for trading on Tuesday, and clear protocols, of course, for trading on Wednesday. So we're going to talk about all these different things, but we have to take them step by step. So for now, we're going to work on Thursday, and potentially tomorrow we're going to do Friday, and then we'll do a little bit of back testing, and then we'll cover some more profiles. But we're going to talk about the criteria for this specific profile. Now, this specific profile being covered is a Thursday TGIF late Wednesday reversal. So this is strictly when Wednesday makes a reversal profile. So we're looking at late Wednesday to early Thursday, just like we talked about on our checklist summary, right? So we look for a late Wednesday to early Thursday to make that intra-week reversal, and then we look at New York session. Okay, that is our window of opportunity. New York session as our continuation trade, right? So again, these are clear specific criteria for trading TGIF during New York session with this specific market signature. Before we go and look at the actual model itself, we need to talk about risk factors. What are factors that would reduce the probability of our trade? So now, whenever I talk about risk factors in any model, maybe this model, any future models, just understand that a risk factor simply means what makes our trade low probability, what low probability events. That essentially is what risk factor is all about. Now, when we're looking at Thursday TGIF trade, one factor that actually affects a trade is NFP release. Right. So what I can do here is, if I can just cancel this real quick. I'll just cancel this a little bit real quick, and then we're gonna move on over to euro dollar. So I want to take you back to 4th, I believe. I think that's 4th of November, if I'm correct. Nope, I'm not 4th of November. Oh, we're just gonna go back just a little. Let's see if we can find what we're looking for. I do believe that is 4th of September, not November, actually. Yeah, so 4th of September. Okay, so now this is Friday. I'm going to use a replace tool here. All right, so we're going to cut all of this off. So now this is NFP Friday, right? Of course, you can see with the volume of the candle that this is, of course, NFP release on Friday, right? Now, let's just study the profile between Monday going into Friday. Now, this is Monday. Let me just delete Monday real quick. So we have Monday in here. and Tuesday in here. Wednesday, of course, Thursday, and finally we've got Friday. So we just did a little bit of shallow analysis, not going super crazy in terms of reading the market because, of course, this is just back testing. Now, what you can see in here is we have this low here and we have this bullish order block. Now, I've talked about stop run inside a order block being a powerful signature in price. So what you get in here is you get that stop run, right, inside bullish order block, and then you get displacement. Right, so the market expands away from there. Does not take our buy-side liquidity though, so we create the fair liquidity in here, right? So the fair liquidity is whenever the market gets super close to a short-term high, not a short-term high, but whenever the market gets close to a high or low and fails to trade up into that, and we still expect the market to trade into that liquidity, then that is what we call the fair liquidity. Usually that is a way for price to build in more liquidity or engineer more liquidity, right, in direction of our drawn liquidity, and then eventually the market runs through that liquidity, like you can see here on a Friday, right? So what we get here on a Monday is that initial expansion on Monday, then you get your classic valuation by speculation on Tuesday, where the market just suddenly runs aggressively against the intended direction. That catches everyone off guard, confuses everyone as to what is going on, and all the market was doing in here was the market was running into this daily fair value gap, right? So we have a daily fair value gap here, which we trade down into on a Wednesday, right? So now let's go and take a look at price action on the lower time frame, since we already have the context of the high time frame profile, right? So on Monday we open up like this. Now, typically we don't like to trade on Mondays, all right? Monday usually is low probability. The only time we trade on Monday is when the previous week, Thursday or Friday, makes a long-term high or low in direction of high time from order flow and has failed to expand yet, right? Now, you can clearly see in this situation, Thursday and Friday were clearly trending. So that completely invalidates Monday as a day where we go and look for any sort of trade. So Monday is a no trade day, right? So what we get here on Monday essentially is, a little bit of a run higher, and then on Tuesday, of course, you get that valuation by speculation during London session where the market just absolutely melts, and on Wednesday you get that stop run below that short-term low into fair value gap inside daily discounted rate. So that is our high time frame level, which is what you get on the Wednesday. Now look at what happens on Thursday, right? Thursday ends up being just a dot. Do you remember this trade? We actually took this trade on Thursday, on September. We did take this trade on September on a Thursday, right? Only for us to end up closing the trade and the market does it like this. And we're so pissed off. If you remember, we're so mad. That is a risk factor because we had NFP Friday. So because we had NFP Friday, what you can see on Thursday is Thursday just ended up being almost no volume whatsoever. Now, what we get here is bullish order block, stop run, propulsion block, and that's what we traded our wins on Thursday. And we held this trade and waited and waited and waited and waited and waited and waited until we got super frustrated and decided, you know what, we're just going to close the trade. And then we closed the trade only for us to wake up on Friday and the market had already moved significantly. And we're like, what is going on, right? That is the same profile, right? That is the same profile, but just a lot more muddy price action due to that economic release on Friday, NFP. That's why that is a risk factor. So now, the thing with this risk factor here is that we don't completely avoid trading. Now, because it reduces our probability, we can either choose to avoid trading, or if we look to trade, we strictly seek short-term trades strictly via offset accumulation. So offset accumulation simply is when the market does a form of manipulation, aka stop run, right, prior to reversal, right? So if we're looking to be a buyer, we wait for a stop run on sell-side liquidity before the market goes higher. but it has to. We cannot day trade. We cannot afford to day trade if there's an FP Friday the next day, right? Because if you day trade, there is a higher probability that the market will go back and forth. And the easiest way to lose a lot of money in a back and forth market is a day trade. You can ride out just really nasty or muddy price action just by switching your profile, switching your trade profile from a day trade to a short-term trade, right? So what you can see here is if you are day traded inside this trade, you're most likely losing a lot of money. A lot of money is what you're losing trying to day trade like this. But if you short-term traded, and because of course if you're going to short-term trade, then your stop loss is way different, your targeting is different. And if we took something like this as a Thursday Tgif profile, anticipating the market not trading below the slowdown here, buying off of that propulsion block, and of course targeting defer liquidity higher, then essentially get yourself a really, really nice trade. Now, because this is a short-term trade, just like we talked about on our profile, we look for H1 to H4 targets, and we look for 2.5 to 5 hour as target 1, which is what we get here on euro dollar. Now, of course, you can see I am cherry picking, which is what I'm doing here. To be fair, I am absolutely cherry picking on this example. But now the cool thing about this is we are actually going to backtest this. It is a fucking lot of work, and this is what I've signed up for. So once I'm done with the presentations and everything, we need to get actual data backed for each trading model, right? So we need around 3 to 6 months. And also one thing I am thinking of doing is paying one of you guys money in the Discord to actually do the work for me, right? So you watch the model, you have an in-depth understanding of the model, and then you give me a data, or I just need data of the model, which can then be presented to students, and then you understand the data, and then it is all about what little tweaks can be made to refine your data. That is all what it's all about for a model, right? So Thursday risk factor: when current market price action is close to an item from liquidity, we avoid reversal trade. We don't trade any side, we simply avoid. Okay, so when we talk about risk factors, there are two approaches to risk factors. Remember, risk factors all about low probability. What risk factors or what conditions reduces probability of the market moving in our direction is the main question we're asking ourselves. Now, not all risk factors are built the same. Some risk factors, there's still a chance you can trade them. You look for either other confirmations or some things to, confirm price delivery. And then there are other risk factors where it is just strictly do not trade. This is one of them. When current market price action is close to an item from liquidity, we avoid reversal trades. That's all. The reason why is because whenever the market is close to high time from liquidity, there's a strong chance that you don't get any reversal because the market wants to reach up into liquidity. So again, I don't have any example in mind, but we can quickly just skim price action. Let's just take a look at cable, for example. We can actually skim price action, and it should, show us an example. So I just want to look for, where price was close to an eye time frame target objective, and it was a Thursday or Friday. So I do think we have one good example in here. Right, so you can see that rejection block here. Market is selling off. We have a rejection block in here. Now let's go and take a look at what the market does on Thursday if we are offered a TGI profile. So this is Friday's price action. That is that high time frame level. Now, what you can see here is Monday, the market opens, we start to sell off. Tuesday, just a lot of back and forth. We have a little bit of a stop run on Tuesday, right? And then going to Wednesday, the market retraces back up into premium array. We have propulsion block in here. really nice sells on Wednesday that we get on cable, right? Off of inefficiency after taking out buy sell liquidity, right? Great. Thursday, you would expect a TGI profile, but you actually did not get a TGI profile. The market continues to sell on Thursday. So if you maybe looked at this initial rally, because it's easy to convince yourself. Let's see if we can actually go to the M15 time frame profile. Yeah. So it is easy to convince yourself that, oh, well, this is actually a reversal and the market should rally from this on Thursday. But the market does not. It just continues to go lower. Why? Because we have a higher time frame sell-side liquidity down here. Like, I want you to think, do you think the market is just going to make a TR profile from here and then reverse and continue to go up when we've not even taken out the rejection block? Maybe if we're taking out the rejection block, then you could say, okay, well, it makes sense to expect a bit of a reversal. But we're so close to, again, it is about proximity to liquidity pool. Not just any liquidity pool, but an 8 to 20 to 60 liquidity pool. So when we're close to a higher time from LP, right, we avoid reversal trades. Number 3 is during mega trade environment. So a mega trade environment is an environment in which we have a combination of fundamentals. So we have a combination of COT report, interest rate, open interest, and of course higher time frame technicals and seasonals. When we have all of these 4 things combined together, this is what I call, well, you can call it the holy trinity of fundamental analysis, but this is what I call these are conditions that essentially creates for a mega trade environment, right? And in mega trade market conditions, markets tend to be really one-sided. Again, just really quick example. The one I can remember, right, from recent, of course, is I do believe that would be DXY. We can also use we had a recent example actually on pound as a dollar. So let's go and take a look at pound as a dollar real quick. So this would be a mega trade environment, right? On pound as a dollar, that would be a mega trade environment. Now we did have sell-side liquidity down here, right? That sell-side liquidity down there. And what we're gonna do is we're gonna look for our Thursday, right? That is Friday, and right here. Or that actually is not a really good example of a one-sided mega trade. Let's look for another one in here. Okay, so we have the buy side liquidity up here, which of course is target objective and pound as a dollar. Bullish order block, market trades up, breaking structure, trades back down to bullish order block, expansion away from there, stop run inside order block, which again I've taught you is a really powerful confirmation. And we start to get that just parabolic expansion higher, right? Now, if we're going to take a look at price on Thursday, right? Now, what you can see here, you can see how just parabolic the market was. Monday, the market opens up, a little bit of a consolidation profile, and then Tuesday, the market starts to run up. Wednesday, the market starts to run up, unrelenting. So, again, when we talk about really one-sided markets, we're not talking about like the usual kind of price action you use. So the usual kind of price action you're used on currencies is just a lot of back and forth, right? Where at most you're getting 1 to 2 days of clean price, clean one directional movement. But for the most part, the market is usually in a back and forth. Right? The market goes back and forth and back and forth. You get a bit of a move, But it is so hard to, especially if you're short-term trading with a little bit of a wider stop, it is so hard to get like a 5 hour move or 6 hour move or 7 hour move or stuff like that, right? So for the most part, you have to content yourself with like 2-3 hour plays. But in a mega trade environment like this, again, I don't want to go and do a lot of like work and stuff. But in a mega trade environment like this, the market just moves one-sided. If you try to trade a TGI profile, you will lose a lot of money. You will lose money. Not a lot of money, but you're going to definitely lose money. Because in markets like this, the market is just it's just way too one-sided. And you can see that in the actual lower time frame structure itself. You're not getting a lot of like retracement. It's just a lot of one-sided, just continuation. I think we do have a good example as recent as USD CAD, I believe. Because we did get a situation where USD CAD was just absolutely one-sided. Higher, right? Thursday, Friday, no. Actually, you can see that here in USD CAD. So look at the rally on USD CAD for Monday, right? Monday we had a bullish expansion, barely any significant retracement. Tuesday we had a bullish expansion, barely any significant retracement. Again, Wednesday we had a significant expansion, and then the market makes one significant retracement. Would it make sense for you to expect the Thursday TGI profile? No, the market does not offer you that. Now, I do think there's a chance we can get a Friday TGI profile because we failed to see the TGI profile on Thursday in USD CAD. But again, we're not looking at foresight. This is strictly hindsight because we're talking about our profile. Look at how bullish USD CAD was. Because the whole time, it was actually bullish. And then the final part of a Thursday risk factor is if Wednesday makes a long-term swing in the direction of items from order flow, of course, you would expect Thursday to continue that displacement. So it does not make sense for you to try to fade that. So that would be a risk factor. In this situation, you do not trade. In mega trade situation, you do not trade. When current market prices close item from liquidity, you do not trade. And then, of course, on April Friday, you have to be selective about your trade, right? Okay, now let's talk about criteria for this specific profile, which is late Wednesday reversal. Now, criteria we're looking for is lack of significant displacement, overextension after Wednesday reversal, right? So for us to go and take the trade on Thursday, we don't want to see a massive expansion already on Wednesday, which causes Wednesday to overextend, right? So we don't want a situation in which Wednesday was just one massive move. Again, I'm going to take you back to examples because I do feel like whenever I make points like this, it is crucial that I show you examples so you understand what that looks like, right? So again, most of these are ingrained into my brain, so it is easy for me to just remember where the price action was and reference them as an example. So I wanted to talk about an example where we did see significant expansion on Wednesday, and that just caused Thursday to just be really lethargic in terms of a TGIF trade. Let's see if we can actually find one. No. Hopefully I can remember what it looks like. So we're looking for a Wednesday that in which we saw we already saw like significant expansion in price. I think it was a bullish example on Euro US dollar, but we're going to find out. Let's see if we can get it. That is Thursday. Let's go back a little bit. Okay, so we're gonna look for good examples. Yeah, so we do have a good example here with euro dollar especially. This is from 27th of August, right? So we're gonna go look for 27th of August in cable. If my memory serves me right, I do think we, Cable was a better example for what I want to talk about. So 27th of August. All right, we're gonna look for that. 27th of August. All right, so now get rid of all of this. Okay, so yeah, I was absolutely correct. Better example on now what you can see here for that Tgif profile, which is it's a little bit similar to what you can see here. Monday, Tuesday, lower expansion. Wednesday, reversal at high time from discount plus S&T profiling. Thursday is where you get your continuation trade. Now, one of the criteria for our profile here is that we don't want to see significant expansion or overextension from that when it's a reversal profile. Now, if you look at this one, it's a reversal profile on cable, you can see that we had a really significant move, right? Now, of course, we could see that the general liquidity would be up here, and we have a lower level general liquidity up here on pound, British pound, US dollar. But what you can see here is we had a significant move, right? 85 pip move we had on Wednesday. And then guess what happens on Thursday? On Thursday, it's a lot of chop and chop and chop and chop and chop, right? On Thursday, right? But now if you compare that to what you can see as recent as this Wednesday going into Thursday, if you remember during the last time I told you why we expected to see a lot more range in cable and also euro, right? Because we barely saw any significant expansion on Wednesday, right? It's all on the last stream. Okay, so that is one of our criteria for looking to trade on Thursday, because we're banking on the fact that we're going to get a lot of volatility on Thursday, right? So we're looking for that. We're looking for a 1 hour market structure shift, which is necessary, or 4 hour change in state of delivery plus inversion. So we're not only looking for a change of delivery, we're also looking for an inversion level, right, on the 4 hour time frame profile. But on the 1 hour time frame profile, we require a market structure shift from that higher time frame discount rate. So now in this example here on cable, you can see our high time frame discount is that daily fair value gap. So we have a breaker block in here, clean lows, the market runs lower. That is a breaker block, right? So let me just get rid of this so we're not confused. So this is an high time frame discount rate in here, and what you can get there is essentially, if I go down to the M15 narrative, so if I take my Fibonacci and divide the range, you can see essentially we're trading around the main threshold of that high time frame level. So we have a consolidation in here, right? Consolidation in here with SMT confirmation profile, and you get your trade away from that consolidation. So that is your market structure shift, right? So you get that confirmation of a market structure shift. Now, if you cannot visually see that market structure shift, then if you go out to a 4 hour time frame profile, it should show as a change in self delivery. Now, we don't only want to change self delivery, we also want an inversion. So we're looking for in a bullish example, of course, we're looking for a previous fair value gap to be traded through and inverted, right? That is confirmation that lower time frame order flow has shifted to bullishness, right? So that is what we're looking for as confirmation that we're now aligned with lower time frame order flow. All right, so we don't want to be trading just because we saw a break in, a change of delivery on the 4 hour time frame profile. We also require that, fair value gap inversion. Okay, we're also looking for a clear engineer lower time frame target liquidity between Monday and Tuesday. So we're looking for Monday and Tuesday to engineer liquidity. Now, the reason why we look for this is because typically during the early portion of the week, there would be protected positions, right? So Let me talk about the concept of that chaos theory. I introduced the concept of chaos theory a few days ago. Chaos theory essentially is just market psychology, right? Again, I've talked about how every good model has a form of market psychology to them. Now, as the market from the start of the week, as it starts to run lower into that high time from discount, there starts to be a lot of excitement by retail wanting to align themselves with that displacement, with that move. Usually at that high time from discount, that's where we have what we call peak euphoria, where shorts, because we're bullish in this example, shorts are really excited. They're really excited about their shorts. So what do? They protect their shorts above the most obvious resistance level, right? Usually that will come in form of intra-week liquidity, right? So what you can see here is Monday's high. That's why I told you that cable should go up into Monday's high. And also the target objective I gave you on euro dollar, that was also the same thing, right? That it should go up into that Monday's high, right? Because that's where individuals who were short, remember, as the market, if I use a replacement like this and I cut all of this off prior to the consolidation profile, most people are not thinking the market is going to flip and go bullish. Everyone's excited about the shorts. Okay, as the market cheers lower like this, everyone is excited about the shorts. You know, there's shorts and shorts and shorts. So what can you see in here? This is a triple top. That is a resistance level, right? So if you're short all the way down here, you're looking to protect your positions up here. That's that engineered liquidity. So we're looking for that intra-week engineered liquidity. And of course, the market maker model, and I've explained the need for that market maker model because that becomes the framework for our Thursday trading, right? So essentially what we're looking for is engineered liquidity between Monday to Tuesday, pick your euphoria as a market trades insights from discount, SMT profiling plus intermarket analysis plus market structure shift or forward time frame change in sale delivery plus inversion level, and then going to New York session. That's our kill zone. So during the New York session, we are looking for a retail confirmation. We're either looking for false support or resistance. We're looking for market maker traps. I've talked about all of this on the course. Again, look at the video. We're already way too long on the video, right? So what I'm actually going to do here is I will talk about checklist, right? We will discuss some confirmation checklist for tomorrow's video, continuation of the video. So the checklist comes in form of bonds, and also we're going to look at price in form of retail confirmation. And that's a little bit of a tweak to our system. And then from there, we need to start talking about performance of the model, performance of the system. So how many times when this condition presented, were we able to see the market actually move to target objective? What was the average, risk to reward? Did we get like a break-even trade? All of that stuff needs to be covered on, the backtesting system. So it creates kind of like an expectation, gives you what to expect when you see a model like this. So I'm going to leave you here, and I'll see you in the next video. In the meantime, trade safe. Peace.